Hello, everyone. Today on the Final Bar, it's Thursday, April 13th. We'll be talking with Mish Schneider of MarketGauge.com. We'll see some of the charts that she is looking at as we continue through this choppy environment, but the market netting out to a decent update with the FANG sectors leading the way higher. Ladies and gentlemen, this is the Final Bar. Hey guys, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Today, coming to you once again remotely from Columbia River Gorge in Oregon. Thanks for sticking with us this week as we do the show remotely, but have fun doing it. The StockCharts TV crew back in Redmond, Washington, making sure things are running just fine. We're going to talk about this market environment. Yesterday, we were talking about sort of not necessarily the risk-off feel, but certainly the rotational feel away from the FANG stocks and into some of the other cyclical names, things like energy and industrials. Today, we're right back to those previous themes with the growth sectors like consumer discretionary, communication services, technology, having a decent update, all up about 2% for the day. Things like utilities and real estate, traditional defense lagging behind. So we're going to look at some of those themes, not just today, but what the big picture represents. We had a little bit of earnings today, really start a little more aggressively tomorrow with a lot of the big banks reporting. So let's get to some of those charts here as we begin our market recap. As I alluded to, choppy day, but overall today, during a choppy week, today was sort of a net risk on, sort of growthy move to the upside through the course of the day. No real hiccups, to be honest with you, during the course of that trend. The S&P finishing up 1.3%, closing just below 4150. The Dow is up 1.1%. The NASDAQ composite up 2%. So it's very much growth over value, generally speaking, and certainly growth over defense. Offense over defense is the way I would certainly describe today's trading. The S&P 100 mega cap index, worth noting, was up 1.7%. Mid caps and small caps up as well. The only thing down on our front page is the VIX, which is actually to a new swing low, maybe for the year. We'll look at that chart here in a minute. But the VIX is actually back below 18. Let's look at some other asset classes here quickly and see what kind of things we can find. Interest rates overall moving higher, and that's more the mid-long end of the curve, with the 10-year yield up about, let's call it 3 basis points to 345. You can see that bond prices, of course, going lower. The UUP, which is a dollar ETF, was down about 0.5% today. Commodities overall a little bit mixed as well, although gold and silver moving higher by about 1.33%. That's using some of the more liquid commodity ETFs. Interesting today to get sort of a risk-on feel with stocks, with growth stocks leading higher. But gold and silver also moving higher as well. It's interesting. A lot of times I feel like we get trapped into a narrative. Gold should do X because stocks are doing Y, or gold should be doing blah because interest rates are doing blah. At the end of the day, what I've learned from years and years of studying charts is the market doesn't care what you think should happen. The market analysis, and I would say technical analysis, is all about what is happening, right? So I remember having extended debates with our gold portfolio manager when I worked at a large investment firm, debating whether, why gold should be going up or going down. And my reinforced comment, I kept reinforcing, doesn't matter, right? The fund doesn't care what you think gold should do. Let's follow the trends. And if the trend in gold is higher, which it appears to be, let's continue to follow it until proven otherwise. Speaking of things in uptrend that probably deserve the benefit of the doubt, Bitcoin, Ethereum, and the other of the top 10 most liquid coins that we track in crypto land on StockCharts, all in the green today. Bitcoin up another 1.5%. Ethereum up almost 5% today. Ether's up above 2,000. We're going to look at that chart here in a minute as well. We've talked about that 2,000 level, the big round numbers that so often become important in cryptocurrencies and other assets as well. But particularly with cryptos, I've seen them become very, very important. Ether now back above 2,000, which is an incredibly important level, I would argue. Bitcoin, well above 30,000, right? At 30,340 and change. Let's go to a daily chart of the S&P, just see how today's trading fits into the big picture. And here's our daily S&P chart. So what we've talked about here for a couple months now is sort of this general range. And I would argue that the range as I defined it really started in November and December, right? When we reached that peak of 4,100 in late November, early December, When we then pulled back, and that first big pullback after the November swing high was getting down to around 3,800 on the S&P. That's going right into year end of last year. From there, I would argue February was a failed breakout above the November high, basically. And then March was a failed breakdown, really unable, or a retest of support around 3,800. So once again, we're sort of at that upper end. And what failed to happen in February was a break above 4,100 that had staying power, right? It's not just trading to resistance, but trading through resistance. And, just as we spoke about back in February, we've broken above resistance. That becomes my new level of support. And let's see what happens next. You can see we pulled back to that 4,100 level and then eventually broke below. And that's what told us we were entering into some short-term weakness, which ended up going through mid-March. That's my question now is, do we get a repeat of that sort of a pattern? If so, I guess the February 2023 playbook is we're sort of at that secondary bounce, but we all of a sudden rotated lower. This is all of a sudden starting to look a lot more offensive, I guess, not offensive, but more offense oriented with growth stocks leading the way higher, with the S&P around 4,150. For me, it's all about, can we hold 4,100, right? As long as we can, I think this is a compelling breakout, to be honest with you, with some potential staying power. But let's stay focused on that level and see if that level can hold. 4,200, of course, is an important one as well. And, I talked to a lot of people in the industry. People are sort of in that 41 to 4,200 range, depending on what you think is the most important. But at this point, I would say we're certainly testing the February highs. The question is, can we get above there? Now, what's interesting about this particular moment is we're in a period of earnings. You're certainly beginning with it, right? Today we had Delta and a couple random stocks. I'm using the StockCharts.com earnings calendar, by the way. And if you haven't seen this new feature on our platform, go to Charts and Tools. In the right column, you'll see earnings calendar. We're adding some capabilities to filter the universe in a little more detail, look at particular sectors and market cap tiers. So make sure you check that out. We'll continue to evolve this space. But upcoming earnings, it's a lot of banks. It's things like JP Morgan, Citigroup, some regional banks, PNC. I remember being, seeing on the list coming up here. And, when you look at these charts, I guess to be honest with you, a lot of these charts, particularly in financials, are sort of question marks at this point. Although if you force me to say bullish or bearish, I'd pick one and I'd probably be able to explain why. For me, though, in all honesty, to be intellectually honest with this chart, I would say at this point, it's sort of neutral. And I would tell you why, right? A lot of these names, particularly JP Morgan that we're looking at, made a new high in January, new swing high, and then another new swing high in February, right? And tested that level, we'll call it around 143. From there, we broke below the 50-day moving average, and now we've bounced off of the 200-day moving average. So now we're kind of in this no man's land between the two moving averages, and we're certainly well off the February highs, about 20 points above current level. So one of two things happens, and it could happen as a result of this earnings report coming up tomorrow. And that's why I think it's an important chart to watch, right? Disappoints on earnings, and it could easily see it undercut the 200-day moving average, which would be the first time it would close below there since October of last year. That would not be an encouraging sign. All of a sudden, this looks like a big head and shoulders topping pattern. We break below that neckline. And this chart, which had looked pretty encouraging there in February, all of a sudden looks a little more negative. On the other hand, you get a positive result out of earnings. Maybe there's some optimism that people are not pricing in yet. We get above the 50-day, we're all of a sudden retesting the previous highs, and just like the S&P, then you're in a chart that's a little more bullish than bearish as you're testing resistance. So the question is just, do we get the follow through or not? So I think the chart of JP Morgan is an important one to watch here. I think Citigroup as well. It's literally in the middle of the range from March, right? We got up to about $52 on the upper end, down to around $43 on a closing basis in mid-March. Now we're kind of right in the middle and literally right at the 200-day, right? Look for a catalyst, but I think we have a clear resistance above current levels and a clear support. The real question, I think, as a longer-term point of view on a chart like Citigroup is what fails first, right? Do we get above resistance? Does resistance fail to hold, or does the support level around 42 to 43 fail to hold? And I think whichever way we break, that'll probably tell you a lot about the next couple months, I would imagine. Thinking about just the cap tiers and the fact that when we look at the dashboard today, for example, we see the S&P sort of a large mid-cap index up 1.3%. The S&P 100, of course, sort of a mega cap index, is up a little bit more, about 1.7%, and mid caps lagging a little bit behind, around 0.7%. I'm drawn to charts like MGC, and there are others. These are sort of the mega cap ETFs. This is the Vanguard mega cap ETF. MGC, OEF is an S&P 100 ETF. Both of those ETFs that I just mentioned, pretty constructive. When you think about the configuration right now with the S&P 500, the NASDAQ testing resistance, all these question marks. What's interesting to me is a lot of the mega cap charts, I would say a little less of a question mark, right? If you look, the Vanguard mega cap ETF, MGC, is already at a new high for the year today, new closing high, right? And a new high for the cycle off of the October lows. So if you look at just the mega cap space, surprisingly orderly, higher highs and higher lows off of that October low. I would get negative when that pattern stops being that pattern, right? When you get a lower high or a lower low, that's when something's different. At this point, it's still continuing in that pattern, right? We're making a new swing high on the rally. On any pullback that we might get, my question would be, do we hold the March low? And as long as we keep making higher highs and higher lows, the chart is positive. So I think it's striking that the mega cap charts probably look the most constructive here. That tells me that there's certainly hope for the broader indexes to go higher, because there's so much, these are a significant weight, of course, in our major indexes, the S&P and the NASDAQ. Just to finish off our market recap today, boy, there's so many charts to talk about. I always feel like I'm running out of time with them. I just want to mention two charts in particular. Ether we'll go to. Certainly could talk about the chart of Bitcoin, but we've been talking about the Ethereum 2000 level for quite some time. And we first, I think, really started making noise about this in October of last year. This is when Ether had gotten down to 1,000. Really found support there and then rotated higher. This is one of the big round numbers. We can see these horizontal blue dashed lines at all the thousands, right? 1,000, 2,000, 3,000 and further. And you will find more often than not, the market tends to rotate around these levels. We failed to break out there in August of last year. And from there, arguably, this has been a big bottoming pattern coming off of that resistance. Well, look where we're at. We're right back round trip to the August 2022 highs. The question for cryptocurrencies, can they get above resistance and stay there? Now, that has been the case for the last 6 months. And I think breaking above the November high, which was around 1,700, was pretty significant. The breakout, the pullback, resolving to the upside. Next upside target was 2,000. We've hit it today. We get above this, we have to start looking at further upside targets. And left on the chart, there's not a lot left, up to around 3,000, which is a lot of upside space, a lot of open sky above these current levels. Let's take a quick commercial break. We'll be back with Mish Schneider of MarketGauge. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close. Thanks for hanging with us this week as we do the show remotely in some ways, but it's been a pleasure to bring the show with you to you remotely from Oregon. A couple quick announcements before we bring on today's guest, Mish Schneider. First off, we welcome your questions. We really appreciate you sharing what you're running into as you're trying to use the technical analysis toolkit to analyze the markets using stock charts. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. Don't forget to subscribe to it while you're there. We'll look for your question and hope to answer one of yours live on the air on Friday's show. Upcoming schedule, as I mentioned, mailbag. Next one will be tomorrow on April 14th. Next week, 3 fantastic guests, all CMTs, setting up for our appearance at the CMT Symposium the week after. Ari Wald from Oppenheimer will be on the show Tuesday, April 18th. On Wednesday, the 19th, we have Craig Johnson, who's the Chief Technical Strategist at Piper Sandler in Minneapolis. On Thursday, April 20th, Dan Russo, an old friend now with Potomac Funds, is going to be joining us, sharing some charts and themes that are top of mind for him. I want to bring on today's guest, Mish Schneider. Mish is the Chief Strategist at MarketGauge.com, coming to us from Santa Fe, New Mexico. Mish, great to see you. Welcome back to the show.
Thank you so much, Dave. It's great to see you as well. And I want to start by saying you hit the nail on the head when you said at the top of the show that all of the talk about what the market is going to do and what it should do and all the numbers and the CPI and the PPI and the FOMC and on and on and on really has proven to be meaningless, as you said, because the market doesn't care about these typical relationships. So I just thought I loved hearing you say that, because that's really what it's all about right now.
I love that. Thanks for saying that. A former therapist used to call that shoulding all over yourself. If you keep saying should do this, should do that. And I find that with investing as well, right? I don't worry about what should happen. Focus on what is happening. Let's get to your charts that really tell, I think, a really compelling story about what is happening. We're starting with regional banks. Certainly important this week because we have earnings starting next week. A couple regional banks represented. What is the chart of the KRE telling you here?
Well, what's so interesting about this chart is that it's almost become somewhat about a month ago or so, in the beginning of March, when it started to break down, actually even before that, under the 50-week moving average, it almost became a lead indicator that something was rotten in Denmark, right? And so right after that, the stories broke about SVB and all the rest, and there you go. And so I wouldn't necessarily say it's the lead indicator right now, but it is still an important indicator. And this is a weekly chart because you can see that so far, we really haven't done very much while NASDAQ and the diamonds are starting to rally here and some of the other sectors are picking up. And so that tells you two things. Number one is that cycle has seen its day. And in terms of banks, that's not where you're going to go to make any money. And it might even turn out to be a good hedge if you want to be in a hedge for the short side. Or it just could be that the earnings will come out as a surprise and we'll see some serious catch up here. Regardless, if we break down under those three lows that we had there, which all are around 41.50, I would take that more as a cautionary tale than anything else. And if we can get through 44, particularly after the action we've seen today, then I would say maybe not the place to go unless you really like bottom picking, but at least a worry you don't have to worry about in terms of what you're hearing from people like Jamie Dimon, that the bank crisis is not over yet.
Yeah, there's still some. I wonder how many question marks we'll be able to, I guess, erase after this this coming week. But I feel like there's still it's still an open question in a lot of ways. And thanks for highlighting that continued downtrend. Compare that now to the second chart, the high yield ETF HYG. What is this telling you?
Well, this is exactly the opposite. So, right, junk bonds are a place that bond traders go where they want to collect a high yield on high debt companies, which are companies that don't do well and don't have good balance sheets, but pay a much higher yield as a result. That is the ultimate risk on situation, right? And so I've been watching this in the last couple of days when people were starting to say we were going into deep recession and we're going into disinflation and the world's coming to an end. And I'm looking at this chart going, well, bond traders don't seem to think so, because why would they be right into earnings season buying these companies? So you can see that there was kind of a bull pennant there that was forming. This is another weekly chart. And we kind of broke out of the pennant over the 50-week moving average today. Now, we're not at the high that we were a couple of weeks ago, and we still have one day left. But I would say that given what we just talked about on the negative side with the potential of the regional banks, if you want to have more confidence and be a buyer of the market overall, if this closes not only over the 50-week tomorrow after the earnings, but also over the high of 2 weeks ago, I would take that as a pretty confident sign that this rally isn't over. And the second part of that that's really interesting to me is if you wanted to have some kind of target, I would say this could rally up to around 78, which would give you an opportunity to say maybe at that point the SPYs are trading at 440, which means it would get through the 420 and go further, maybe even get everybody in. And then, of course, we know any catalyst could happen that would turn that around. But at this point, this is giving me more confidence than anything else.
And it's amazing. I mean, it's, I guess, arguable as to how constructive it looks, right? Because it hasn't quite broken above resistance from January, but it's certainly not looking negative, right? So it's hard to be super, like how, I always think of it this way, how negative do you want to be when the HYG looks like this, right?
Exactly. And it also is a lesson in trade right now, what has the momentum, and really don't necessarily even look at some of the other places. I mean, it'll give you a better focus, number one, give you much more profits, number two, and it'll also erase a lot of that noise that are constantly being bombarded with right now.
Your next chart, Mish, is Semiconductors, certainly a group that has been, I mean, on a relative basis, one of the better places to be year to date. What do you see in the SMH now? What does it tell you about the conditions here?
Well, this is a daily chart, just to
Yep.
confirm time frame. So I think the last time we were together, Dave, we talked about the 23-month moving average and why all of a sudden this year, it's a moving average I've had on my charts forever, but this year it became really important, especially after we had the great rally in 2021 and then the great decline in 2022. And this year has been sort of the WTF year, and that's exactly what we're talking about, right? But meanwhile, the semiconductor chart has actually been the only one until today, the diamonds took it out, that took out the 23-month moving average. So I decided, let's take a look at the daily chart, because this is going to be also super important. As you mentioned, growth overtook value today. And this is where NVIDIA lives and a bunch of other companies that are going to be reporting as we get into earnings season. And yet it's bouncing off the 50-day moving average. And the key area really to look at right now is around this 246, 247 level, because not only is it the 50-day moving average, but it's also the 23-month moving average. So we can see fake outs of something going over a 23-month and then failing it. So regardless of what's going on, given the other two scenarios I just talked about, junk bonds into resistance, KRE and regional banks not looking great yet, this as one of the leaders really needs to stay in the game. And this chart tells the story.
At the bottom, these are your charts that we're sharing, Mish, and thanks again for sending these. At the bottom, we have your real motion indicator. It's part of your ACP plugin on StockCharts. For those that aren't familiar, I think of it as just a measure of, I guess, a measure of momentum. But how would you describe what the real motion is telling you here on the SMH?
Well, I'm really glad you pointed that out, because this can be either a lagging indicator or a leading indicator in terms of momentum. And very often when we see a divergence, that's when we're interested. So we look for a couple of things. Number one is we look for a mean reversion, which we had just a little bit ago when we were making the highs in semiconductors. It went through the Bollinger Band and broke back below it. And I know you have quite a number of people who are mean reversion watchers. And that's one indication. But look where it's at right now. It's sitting on the 50-day moving average, just like the prices, which means the momentum and also the price are flattening into support, which could be noteworthy. We can't say that just yet. But it also could just be that the market is taking a pause here until we see this next round of economic data coming out. Of course, earnings being probably the number one situation that everybody's looking at right now.
Absolutely. I'd love to talk about a couple other charts if we could with the time we have left, Mish. I want to talk about gold, and full credit where it's due. You were part of our Charting Forward Market Outlook special back in January. You mentioned gold as a really good place to be. Well done on that, because it's obviously been one of the few places in the market that have just been truly resilient, kind of working. I have the GLD that I'll bring up here to take a look at, but I'd love to just for you to just talk about what you see in the gold space right now. Is it too far, too fast? Is it overextended, or something that you would still think about following here? What's your take on gold?
Well, I don't think it's too far, too fast. If anything, I thought it was so undervalued that it's finally starting to look more in line with what our inflation numbers, whether people think that we're in deflation or not, it doesn't matter. To me, just looking at this chart, of course, it's also been the flight to safety, but today where we had more risk on, it still went up. So gold has been in demand from a physical standpoint. There have been countries buying large bundles of gold, number one. But number two, what it's really telling me is that there's a little bit of fear still in the market. There's still a bunch of raw materials that are under siege. Like, for example, if you're looking at the softs like sugar and coffee, if you're looking at copper, even if you're looking at steel, they haven't gotten going yet, but they can. Oil is consolidating, but at a higher level than it was a couple of weeks ago. You know, we're right at around $80 to $82 a barrel. So I think gold is projecting that we're not out of the woods by any means. We have geopolitical situations that are certainly fearful. They may or may not play out, like with China, Taiwan, or what continues to go on with Russia. Also, we have the dollar, which has been declining, the question of what happens to the currency as a world reserve. All of this is right here. So I actually think that as long as we hold this 2,000 level, doesn't mean we can't see corrections. But my prediction has been a move up to 2,400 to 2,600. And now you can see it's peaked out of this Bollinger Band here, which generally means if it stays there, that could be almost like a fat tail trade. I could just be getting going.
It's amazing how gold, I feel like we talked about gold so much last year and it struggled. And all of a sudden, it's so impressive how that market has changed. A great reminder to focus on the trends and focus on what the charts are telling us. Mish, it is so good to see you. Thanks for sharing some charts and some ideas with us. Best to Keith and Jeff and the MarketGauge team. We'll talk to you again soon. All right.
Thank you so much.
That's Mish Schneider. Mish is the chief strategist at MarketGauge.com, coming to us from Santa Fe, New Mexico. I love her discussion. Just think about some of these different areas, particularly high yield. When I talk with Mish, we often end up at high yield debt and looking at the HYG. And what I have found certainly is individual investors a lot of times are sort of underaware, if that's a word, of what's happening in the fixed income markets. And on the institutional side, I was always taught, particularly in periods of market uncertainty and certainly in bear market phases, the best thing to do is call the people in the fixed income team and see what they're thinking about, because bond investors tend to be way more focused on risk, potential risk than potential reward. And as a result, they usually have a really keen eye for recognizing weakness and potential weakness and risk factors. So when things like high yield debt are doing well, that tells you bond investors are getting a little optimistic. It might be an important chart to watch. A great take, as always, by Mish Schneider at MarketGauge. And folks, we got to wrap the show. 30 minutes goes by so quickly, but it's time to go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. You know, there's an article recently that was shared with me about the Copic indicator or the Copic curve, and a couple of my premium members at Market Misbehavior were asking me about it. And I wanted to share you the chart that I shared with them to sort of answer their question. The Copic indicator, which we've talked about on the show. And by the way, who was it? Boy, it'll come to me when we're done. One of my guests has talked about the Copic indicator. We walked through it on the chart here. Jesse Felder, that's who it was. I actually shared it. So if you go to our StockChartsTV.com or our YouTube channel, you can see my discussion with him earlier this year. But the Copic curve is basically this line at the bottom, and it's the difference between the 11 and 14-month moving averages on the New York Composite Index, $NYA, on the StockCharts platform. When this goes down below zero and then slopes higher, that is a Copic curve buy signal. And what it implies, long story short, is the mourning period, and that's mourning, M-O-U-R-N, as in we're very sad and we're mourning the passing the bearish phase, I guess. When that Copic curve turns higher, that suggests or it implies that the mourning period for the market is over and that the trend is now positive. So we have gotten a buy signal from the Copic curve in the last couple of months. We have also gotten a Zweig breadth thrust in the last couple of weeks, which is a measure of breadth, basically a breadth expansion off of the lows. What we have not had are some of the confirmational indicators, and one that I would highlight would be the monthly MACD or the monthly PPO, which is still in a bear phase, according to the New York Composite. You look for a buy signal when the one crosses above the MACD line or the PPO line crosses above the signal. That would confirm sort of this new bullish phase. But it's worth noting that a couple of sort of big picture broad breadth indicators and market indicators have certainly turned bullish here. Another more bullish development to highlight in our second chart is the VIX, right? One of the things we've talked about is this uncertainty in the markets. And I like calling the VIX the uncertainty gauge much better than the fear gauge, because I think it measures sort of instability or uncertainty. How confident are people in the overall direction of the market? When the market is rallying on low volatility, things look kind of like they did in the middle of 2021. Look at this green shaded area. This is when the VIX was often down around 15, and it was sort of a nice, slow, consistent uptrend. The deepest pullback we had in 2021 was like 3 to 5%, and there were incredibly buyable dips on the way up. That obviously changed in 2022. It was very different in 2020 when the VIX was much more elevated. Are we entering into a new mid-2021 style of VIX, which I would argue would be one of the most bullish things that we've seen yet? If the VIX can get below 18 and stay there, happen today. Finally, our third chart, the GBTC. Now, full disclosure, I own this in personal accounts, but it's one of the ways that investors have found to play Bitcoins in an ETF-like product. When a chart is going higher, like Ethereum, like Bitcoin and others, I like to see if it can stay above trendline support. So far, that's a thumbs up. It's doing it. Folks, that's a wrap for the show today. Special thanks to Mish Schneider of MarketGauge, joining us from Santa Fe, New Mexico. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, be safe. We'll see you tomorrow.